Short tonight. We'll see how it goes.
Are you feeling a little ill?
No, I feel fine. I just have a very weak voice. Started Tuesday night.
Oh, okay.
All that yelling at you during class.
I'm sorry I was being disruptive.
No.
Reminded me of high school.
Part of it is lecturing in a room like this with where the projector's noisy. I talk louder to talk over that. And then I've been in meetings all day, and it seems like every room I've been in a meeting in has background noise. Either there's a fan to talk over, or there's some seminar going on where I'm trying to talk over the speaker without talking over the speaker. So I've been much louder. Or I'm talking on the phone to somebody who's constantly saying, "What? What?" Great. That's what I need. Any questions about anything particularly related to real estate finance before we
No,
go on here?
I have a question not related to the chapter.
Okay.
The test that we're gonna take from you that gives us the pass to go take the state test,
The final exam for the
is
course?
that gonna be after, the next course, or is that during this course?
No, you have to take two tests. Each class has to have 25 questions for every pre-licensed class has 25 questions per 15 hours of contact time. So this class will have a 128 question test. 125 is required by law. 128 gives you slightly better odds of passing.
Sure.
And there'll be a 28 question test. Again, because 28 gives you better odds of passing than 25 under the second one. Then you have to pass both.
And then we vote.
Yeah, and then you're eligible for the state exam. What I will say is that although the material is just as hard in the next class, the pass rate is real close to 100%. It's not perfect, but it's real close to it.
Is there a reason for that?
Yeah, it's review and application of what you've already learned.
What's your pass rate for this class?
I don't really even know. I really haven't kept track of what it is. It's not 100%, I can guarantee you that.
Sure.
The highest I've ever had, I think, in a class like this, when it was small, I had 8 out of 9.
That's
which
pretty
that's
good.
pretty high. And that wasn't just pass, those were all really good, but a number of those people had taken this material before. I mean, it's pretty common, I would say, it's probably like 3/4, something like that, but I'm guessing, I don't really keep track of it. Once somebody has taken this class, they're eligible for taking the next one, so you can not pass this course and still be okay taking the next one, as far as the college and I am concerned. Some people will take this class and not pass it and not take the next class. Some people will take this class and pass it and still not take the next class. Some people will take that class without you seeing them here because they'll have come from the previous semester or from the online class. So there's a range of what you see there. Turn this on. Let's take just a minute for that to warm back up. Bring this light out. Any other questions about anything before we get started? I really don't know how long my voice will hold. Let's see.
It doesn't sound like very long.
Yeah.
It's all right with me. Tired.
All right, so this is our second half, if you will, of real estate finance. Real estate finance in various forms and fashions could be as much as 15% of your state exam. It's certainly a big part of what we do because very few people pay cash. And even if they pay cash, some of the stuff we're talking about here might still apply. Not much, but some. All right, so this chapter opens up talking a little bit about the reserve, the Federal Reserve System, and there's not a lot here, and it isn't a bad idea for you to know something about it in terms of understanding how the Fed works. So I've added some information, see if I can even remember it. I was too busy today to look at any of this stuff before I came in here. So there are two money supply measures that the Federal Reserve System uses to measure how much money there is in the American economy, M1 and M2. M1 is pretty much cash or its equivalent, meaning anything you can make immediately available. So cash or checking accounts, and now, which is notice of withdrawal accounts. That's part of M1, immediately available cash. A little bit less available cash includes your savings account, even though you can walk in and withdraw all the cash in your savings account if you want. There are limits. You can only make 6 withdrawals a month from a savings account, according to Federal Reserve rules. If you're going to do any more than that, you should have a money market account or some other mechanism. Money markets and certificates of deposit and other kinds of things are called near money, available to you within 24 hours, but not, according to the Fed, as available. Why do we care? Because the amount of money available in the economy has to do with economic activity. And if you have economic activity that's trying to outstrip the money supply, you've got people looking to borrow money that isn't there. What happens to interest rates? They're going to go up, right? Because the bank's widget or commodity, which we talked about last time, which is cash, if the banks have a limited amount of cash, even if the interest rates don't go up, what are they going to do? They're going to tighten credit requirements so that the people who could borrow money last week can't borrow money this week, right? Because that's what you would do when you're down to your last item on the inventory of shelf in your store, is you're going to reserve it for your best customer or whatever, and that's exactly what banks do. So the money supply is something that the Fed can also regulate. Now, the Federal Reserve is not the Treasury, and they don't print money. So that's not what we're talking about here. I'm not talking about the amount of printed cash that's in circulation or the amount of coin. We're talking about the theoretical amount of dollars that are floating through the system. And the current M1 in the United States is around $9 trillion, something like that. And that's about $1.5 trillion more than it was 5 or 6 years ago. And yet the economy isn't that much better. But in 2008, please don't forget that in 2008, banks literally stopped lending to almost everybody, including each other. When Lehman Brothers failed and Bear Stearns failed, the major banking institutions realized they had no idea. AIG, which was a big counterparty insurer of a lot of debt instruments, was on the brink of failure. The major financial houses realized they didn't know if they could even trust each other to loan each other money, and that created a crisis of confidence. And that's what the Federal Reserve does. The Federal Reserve Board of Governors manages confidence in the United States in terms of the economic system. What backs our currency? What kind of system do we have? What kind of system backs the U.S. dollar? So we got 1 vote for the gold standard. What else? Land. What else? Yeah, it's that. It's a promise. And what's the promise? Whose promise? Who stands behind the U.S. dollar?
The Federal Reserve?
No.
No?
Mm-hmm. You do. Who pays to clean up the mess when there's a problem?
We do.
Everybody in the room, raise your hands. We do. The world knows that the single safest place to invest money is in the U.S. economy, because the federal government here could never expropriate large amounts of businesses or land or things or whatever and get away with it, because the people of the country would never tolerate it. So you don't sort of lose all your assets in one fell swoop. And who's always willing to step in and clean up the mess? We did it in 1989 with the savings and loan crisis. We've just done it recently, the big bank bailout, as people like to call it. Who steps in to clean up the mess? We do. That makes the U.S. Treasury the single most reliable debt instrument in the world. Maybe now, in the euro, but even there, that confidence level is being tested as the European system is being tested by Greece and Portugal and other financial challenges. So the Federal Reserve manages this in part by maintaining confidence, because that's all there is. Confidence in the full faith and credit of the U.S. government. The U.S. government that now owes $17.5 trillion or whatever the amount may be. We should all bring in 30,000 cash or 35,000 cash apiece to class next time to see if we could pay off our share of the debt. And don't forget your minor children. Bring that in for them too. But that's what we're looking at, is maintaining confidence. Full employment is another thing the Federal Reserve monitors, which is one of the reasons why the Fed's still concerned about what's going on in our economy. We don't have a lot of new jobs. We had some, but not as many as they would have liked. So the Fed can manipulate interest rates in a number of different ways. It can increase and decrease the money supply itself. How does the Fed increase the money supply? Anybody know?
Print more?
No, they don't print money.
Oh, that's right.
So what the Federal Reserve does is it kind of creates money out of thin air by simply saying it has it. And it takes, and it purchases US treasuries, mortgage-backed securities, and other kinds of debt instruments, but usually it's just US treasuries. And when the Fed buys those instruments, that puts more cash into the system. And when the Fed wants to reduce the amount of cash in the system, and the Fed simply sells its treasury holdings, and the private sector has to buy them, taking that cash out of the M1 money supply and putting it into M3, which we don't even count anymore, which is not mere money, because it's bonds, not savings deposits or money market accounts. So that's one way for the Fed to manipulate interest rates by buying and selling treasuries, or as it was doing recently, it was buying up to $85 billion a month for a while in mortgage-backed securities. It's not doing any of that now. That tapering, if you heard QE1, QE2, QE3, quantitative easing they called it, the idea was to put all this cash into the economy by buying all these mortgage-backed securities that are normally being bought by private parties, also which created greater confidence in the whole mortgage lending system, we're going to talk about a little bit tonight, and getting the real estate market going and stronger again. Now the Fed has backed out of that entirely. They've weaned us off of that. They're not buying any mortgage-backed securities at all, but the economy is still kind of creeping along at the same sort of pace, private money having picked up the slack. But they're not quite ready to do any more than that currently. When the Fed wants to, they'll start selling these mortgage-backed securities and treasuries and things that they're holding. And when they start doing that, that's going to take more money out of the money supply. And as that money comes out of the money supply, what would you expect to have happen eventually there? Rates start going up. So mortgage rates, something that matter to us, are not directly manipulated by the Fed at all, but they're manipulated in the manner I'm describing here. With the anticipation of long-term rates going up and the anticipation that the Fed's going to start selling these instruments that it has on the open market, increasing the inventory and requiring more money to come out of M1 to buy them up, the idea is that that's going to cause long-term mortgage rates to go up. How much and how fast, nobody really knows, because the Fed keeps pushing back the timeline within which they say they're going to be starting to do this kind of activity. They were going to do this a couple of years ago, and it just economy hasn't picked up enough. Another way the Fed can manipulate money supply and availability is by changing the reserve requirements. So the name the Federal Reserve System is that it's a system that requires federally chartered banks and any other banks that voluntarily participate in the Fed system to put up a certain amount of cash reserves. And the Fed decides if that's 1% or 3% or 5% or what it is. They do it by rule. And they notify the banks that they do or don't have enough reserve requirements. So, or reserves. So if banks have to have more reserves, then there's a certain number of dollars that the banks cannot loan out. They have to keep that on hand so that if you get nervous and you run into the bank and you want all your money, they can actually give it to you, right? If there's a run on the bank, the banks could keep up with that demand. In times of difficult, banking health, sometimes the Fed will require higher reserves just to protect the public, make sure that all the banks have enough money. The problem with that is it pulls money out of M1 and makes less money available. So reserve requirements had been loosened fairly recently so that banks have fairly low reserve requirements right now, also which kind of increased M1. So that's another way that the Fed can increase or decrease interest rates by messing with the money supply through reserve requirements. Open market operations is what I talked about with them buying and selling treasuries, mortgage-backed securities, etc. Then you need to understand the basic idea of this reserve requirements and how it sort of works and how banks can make this function when they don't have enough money. Banks loan out tremendous amounts of funds, and their deposits don't come in completely linear ways. So Tom goes to the bank on, let's take it tomorrow, and he cashes his paycheck, and the bank runs out of money. Your paycheck would do that, right? So now the bank has to meet the reserve requirements, and it's 4 o'clock on Friday, and they don't have enough money. So what do? So they call up another bank, and they borrow the money from that other bank. So through the Fed system, right, the idea of the federal funds rate here is the federal funds rate is the interest rate set by the Federal Reserve at which member banks loan money to each other. So Chase is out of money on Friday, they borrow it from Bank of America for 30 days or whatever at a very low interest rate. Or did Bank of America get the money? Well, they're getting it from, wherever. Maybe they're borrowing it from somebody else, who knows? That liquidity is very important to the system. So these major banks in 2008 stopped doing that. They wouldn't loan money to one another because they were afraid that the bank they just loaned $100 million to was going to go out of business because of the failure of Bear Stearns and Lehman Brothers and Washington Mutual and other major financial institutions. The discount rate is another similar rate. The Fed sets this as well. The discount window is the window that, it's not really a window, but it's a name for give you an idea of going to the window at the bank, where banks go directly and borrow from the Fed. That has a bit of a stigma to it, because what that's saying is, I'm a bank, I need money, and I can't borrow it at a lower rate from these banks over here, so I have to go directly to the Fed to borrow it. So banks don't like to go to the discount window. How many of you remember in 2008 when it came to TARP, Troubled Asset Relief Program, that the federal government, that the Fed sat down with Chase Manhattan, Bank of America, and 3 other banks and made those 3 major banks, Citi was another, take like $25 billion apiece from the discount window? You guys remember this at all?
Yeah.
That's how the Fed encouraged other member banks to come to the discount rate. They forced the big banks, forced them is kind of an overstatement, but they twisted their arms to take money from the discount window so that other banks would come to the discount window to borrow what they needed from the Fed without fear of having a stigma in the market that, oh, you're Old Second National Bank and you need $25 million directly from the Fed, you must be in trouble. Because now everybody was doing it. And so they immediately removed that stigma, and that's one of the things that the Fed did to save the economy in 2007, 2008, is they also narrowed the interest spread. There has typically been a 0.5 to a full % interest rate difference between the funds rate and the discount window. So banks were always better off borrowing from each other than from the discount window, and the Fed narrowed that spread down to about 1/4 of a percent, so that there wasn't a big penalty to banks to borrow from the discount window. So these two they manipulate very directly. The reserve requirements they manipulate, but that indirectly affects interest rates the same way as if you exercised open market operations. So these two are indirect, these two are direct. And when it comes to mortgage interest rates, it really is more a matter of what's going on with the indirect manipulation of the Fed. So really it's the private market that's deciding what the interest rates are. Keeping in mind this is all a very small view of the fact that money that's going to go into mortgages could go into other things. So long-term mortgage rates are also affected by what are the alternatives for those dollars. So if you're managing a hedge fund or an insurance portfolio or something, you have $100 million in cash and you don't know what to do with it, and you need to give your investors a return for the next 10, 20, 30 years, you have options. U.S. Treasuries, Euro bonds, corporate bonds of varying qualities, mortgage-backed securities. All of those are options. And so those funds compete with one another, and the money's going to go where you have the greatest possible return for the least amount of risk. And that's a market decision. So as long as there's money, that money can then decide where it's going to go or what it's going to choose. So the Fed only has a certain amount of control over what happens. But if it does its job well, and I think it has over the last 7 years, then we have a reasonable economy. They don't control a lot of things. They don't decide whether to hire people or not. That's up to individual private employers. They don't decide whether to repatriate foreign earnings. If you're Apple and you've got, what does Apple have, $50 billion overseas? If you're Cisco Systems, you have $35 billion overseas. And U.S. corporations have trillions of dollars overseas that they won't bring back to the U.S. because of tax rates. The Fed doesn't have any control over that. And that has an impact on the money supply in the United States as well. Questions about the Fed at all? I'm not going to ask you about this. I don't know if you get any Fed questions. But the more you understand how the economy works and how money works in the country, the better off you'll understand how finance works. And again, this is important because unless you're going to work with all cash buyers, you need to understand something about finance. So the mortgage market has these two main parts, primary and secondary. Secondary market's in turmoil for reasons I'll explain. Primary market, hopefully pretty straightforward. It's wherever you go to borrow the money. Whatever door you walk through to make the loan application, that's the primary mortgage market. We can compare that, for example, to the car business. What do you do when you buy a car in the primary market? What kind of car are you buying? I don't mean brand. I mean age. When you buy a car in the primary market, It's brand new, never been titled. That's the primary market. You turn around and sell that on Craigslist 2 years later, you're selling it into the secondary market. It's a used car. Even if you buy a used car from the dealer, that's really a secondary market, right? Because it's not the original title holder. Primary market in the stock market would be IPOs, right? That initial price offering when a company first launches or first it makes a stock offering. Your private company decides to sell stock to family and friends. That's the primary market. But once you have a certificate and you decide to resell it to somebody, you own 100 shares of General Motors in your retirement plan, and you decide to sell that, secondary market, right? You're just selling your shares to somebody else. You're not buying them from GM at that point in time. So that's what happens here. So the primary market, the originators, which in all cases are using their own money except mortgage brokers. Mortgage brokers don't use their own money. Mortgage bankers do. Mortgage brokers do not. They're all the originating lenders. Secondary market, that's not the case. Those are used loans, which we'll talk about more in just a minute. So let's talk briefly about the difference between mortgage brokers and all of the primary mortgage market originators. Mortgage brokers are dealers, basically. They have relationships with usually multiple lenders, and they act like the brick and mortar or online storefront for the real money, which is back behind them. So you go to a mortgage broker, it's kind of like going to an insurance agent that represents multiple lines of insurance. If you go to a certain agent, they may only represent Liberty Mutual. You go to a different agent and they can get you Aetna, they can get you, Ohio Casualty, they can give you 12 choices. But when you're talking about a mortgage broker, they're like the latter. They represent multiple banks and or other kinds of lenders. And they act as their representative, their storefront. So when a mortgage broker, when that firm originates a loan, they get paid a commission from the lender. And they'll get paid a premium based, in some cases, on what the interest rate is. There's an incentive for mortgage brokers to have clients who pay a higher interest rate because the lender will pay them more money. Because the potential return for the lender is much higher. And if you talk about spreading something out over 30 years, 1/8% or something really large, like 1/4% over what you might be able to get, is an incentive for the broker to sell you the higher price deal. So keep in mind that the obligation of a mortgage broker is not at all the same as the obligation of a real estate broker. We have fiduciary duties. We're obligated to advocate for our clients, etc. Mortgage brokers, that's not the case. They need to know what they're doing. They need to disclose truthfully. And if they're making a yield spread premium, that has to be disclosed today. But it's still acceptable for them to do so. And it's up to the consumer and or the consumer's real estate agent to help them figure out this is what's happening. You still probably get a better deal in many cases going to a mortgage broker because they have multiple choices. Whereas if you go to one bank, you're going to get whatever that one bank's arrangements are. And mortgage brokers tend to be more creative because they have more venues. And they only make money if they make the loan is put together. Whereas a loan officer at a bank might be getting a salary. All right, so that's just a little bit about mortgage brokers. One more thing. I just mentioned this here. Mortgage brokers have also evolved a practice which is kind of interesting, which is particularly in relationship to refinancing, which is to pay the closing costs on behalf of the borrower. So if you go to your local bank, the odds are they are not going to waive their closing costs. They're going to charge you these fees we talked about a little bit before, and whatever loan origination fee, whatever they're going to charge you all that. You're going to pay for title insurance and other kinds of things. But a mortgage broker may cover that for you. If a mortgage broker, for example, can earn a $4,500 commission from the lender, and your closing costs are going to be $3,500, in order to entice you to refinance, they may say, we'll cover your closing costs. To you, the lender isn't charging you any, but that's not what happens. The mortgage broker covers it out of their fee. Why do they do that? Because they're hoping if the rate creeps down another 1/8%, they can call you up again and say, time to refinance. And again, they'll make another $1,000, but you don't have to worry about it because there's no cost to you to refinance because they cover all your closing costs. And that's worked really well so long as interest rates have constantly been dropping. But as we go into an environment where interest rates are probably going to start creeping up over time, even if it's only 0.5% or 1% or whatever, that long-term trend tends to be upward, that system may not work quite as well. We'll see. Particularly with adjustable rate mortgages and combined with mortgage brokers' willingness to pay most of their commission into covering your costs to entice people to refinance more frequently, has had a big impact on the refinance market. All right, secondary mortgage market, the used mortgage market. What lenders tend to do, and if you haven't seen these slides, there's some kind of diagrams we'll look at very briefly here, not for me to go over in class, but for you to be able to look at on your own, so you can figure this out and see if you can understand. The basic idea is that lenders originate loans, and rather than hold them in-house, and a lender that holds a mortgage loan in-house, it's called a portfolio loan, and very few loans are portfolio loans anymore. Most residential loans are sold into the secondary market. And as I put up here, Fannie Mae and Freddie Mac, who are the two biggest agencies who do this, had for ever been government chartered, but they were always privately owned. Today they're 80% owned by the federal government. The federal government's still trying to figure out how to get those completely back into private hands. For right now, they're concerned that the mortgage market might collapse if Fannie and Freddie weren't really just agents of the U.S. government. So Old Second, for example, originates a loan locally, and every loan like it, maybe it's a 30-year fixed rate loan at 3.875%, 3 7/8. And they've originated 30 of those this month. And they can package those 30 loans, and they can sell them all in one pool, as long as they're within a certain time frame. They can sell all those loans to Fannie Mae or Freddie Mac, whoever will give them the better deal. And the bank gets their cash back. They pocketed fees and things up front. That's why they need the fees. They won't get the long-term interest income on the loan. Instead, they pocket the fees, and they don't want the long-term interest rate risk. They pass that off to the secondary market. They get their cash back, and they turn around and loan it out again, generating the fees. So this is how our local banks are making money these days. They're basically loan originators, and within 30, 60, 90 days, they're selling these loans off to the secondary market. They do that because they remember, institutions have long-term memories. They remember what it was like to have interest rates at 15, 18, and 21% in 1977 and 79 and 81. So in order to avoid that long-term interest rate risk, they simply pass it off to somebody who's better able to handle it. I am told that there will be no Fannie or Freddie questions at the state exam until the situation with Fannie Mae and Freddie Mac changes to become a permanent long-term solution. This was something that was told to me 6 years ago, and I've never heard that change. So I don't think you need to really study Fannie or Freddie themselves in terms of exactly what they are or how they work, but it's still important to understand what they typically are. They're publicly traded. You can go online and open your stock account and buy Fannie Mae and Freddie Mac stock, but if you wanted to buy all of the available shares, you couldn't get more than 20% because you have 80% of it's owned by the federal government. What that does, when we talk about loan guarantees in just a minute, or portfolio guarantees, remember, who do we say is the single most creditworthy entity on the planet? The U.S. federal government. And today, these two are basically agencies of the U.S. federal government. So instead of having an implied guarantee like they used to, they have an explicit guarantee. Unless the federal government's going to default on its treasury debt, it's not going to default on its mortgage-backed security obligations when it comes to the investment capital, etc. Ginnie Mae is, always has been, and I'm sure will be, an agency of the federal government. It's a division of HUD. And Ginnie Mae does not buy mortgages the same way that Fannie Mae and Freddie Mac does. So they issue what are called pass-through certificates. So the money sort of passes through, basically. And what they do is they guarantee the money on loan programs that are already federally guaranteed, like FHA, rural farm home loans or whatever, that kind of thing. And I put others down here in the secondary mortgage market just to let you know that anybody can buy loans in the secondary market. This is why we had the major financial meltdown, in part. So much money was being made in the secondary market because real estate values were just constantly increasing. I think I mentioned to you earlier in the class, but I'll say it again, the record increase, year over year, market increase in one real estate market is 51%. In Las Vegas, from 2006 to 2007, the price of an equivalent home, for example, was $400,000 in 2006 and was $600,000 for the same stinking house 1 year later. When you have that kind of appreciation, lenders really stop caring about a lot of the lending metrics and underwriting concerns, because even if you default 2 years later, at those kinds of appreciation increases, they go through the whole foreclosure process, they get made whole, they get back every dollar because of the phenomenal equity increases. And that made lenders lazy. It took away some of the risks, so they stopped underwriting as closely, and that's why we got into trouble, because of these huge run-ups in value. The run-up in value could occur in part because we don't really care what we pay for a house in terms of how many tens or hundreds of thousands of dollars. If you think I'm crazy, think about it for a minute. How do you really measure how much house you can afford? By what? The monthly payment. So as interest rates come down, what you can afford goes higher. And if you can afford something higher, what does the market do? The market allows those costs to work up higher because people keep paying for them. So we had all these investors and other people buying into the market, driving it up in kind of a way that people didn't realize was kind of a, the emperor's wearing no clothes sort of, fake market support. And all of a sudden, the music stopped and everything dropped all at once because it had overheated and moved up too fast. So it was a combination of factors, not the least of which was that a lot of others, a lot of banks with excess capital were saying, wow, we can make a lot of money. Remember the whole subprime loan idea? Subprime loan is one that's less than quality prime meat, right? Prime meat is the best meat you can buy, federal, FDA reviewed, whatever. Subprime means less than that. So a subprime loan is less than ideal. So for those of us who were borrowing under subprime loans, we would get an adjustable rate mortgage at the current, say the market today for ARMs, 5-year ARMs is 3%. We'd get a loan at 4.5%. And it was going to adjust up to 9, 10, 12, 13% according to the loan docs. Even though the people who were borrowing it were probably never going to be able to afford that at that time, the banks didn't care, because all they could see was it doesn't matter, because at 20% a year increases in California or Florida, these people will be able to sell the house in 2, 3, 4 years and make money and pay off the debt, and they'll be happy and we'll be happy. And that all worked in theory on paper until it didn't. So many banks failed in part because they were holding all of this mortgage-backed security debt, because instead of Fannie and Freddie buying it all, with the government sort of behind them in those days, private banks were buying it. And that turned out to not be very good. The almost first failure in this area was E-Trade, for example. Those of you who are familiar with E-Trade as a stock brokerage platform, E-Trade also had a bank, and they were heavily invested in second mortgages, and it almost took them down. And a venture capital firm that was an investor in E-Trade pumped billions of dollars into E-Trade, and that almost took them down because they did it too early in 2007. Citadel Finance put money into the company. E-Trade only really started recovering about a year or two ago. And they're really only recovering because the market's coming back and the values are coming back. So the value of the property underlying the loans is coming back. So fewer people are defaulting. If the real estate market stayed down, a lot more banks would have failed. Anyway, that's the whole idea of that whole system. Just kind of understanding what happens there to whatever degree you can is helpful. Give you a way to view, your economic activity and be able to read it. So this is one of those slides that I imported into here just basically for your own benefit, to give you a sense kind of what happens with a loan. So here on this side, basically, the borrower wanting to make an application, working with their primary mortgage market participant, whoever it might be. Maybe they're going to a mortgage broker, or maybe they're directly sitting down with the lenders. The broker may or may not be involved. But either way, here's the borrower, here's the primary market at work. And then you've got whoever is, actually originating the loan. They're going to sell this thing into some kind of mortgage pool. Mortgage-backed security is kind of exactly what it says. It's a security, meaning a debt instrument that's backed by mortgages. The mortgage being the promise you can take away my house if I don't pay. So investors, from insurance companies with, that have to make annuity payments, to sovereign wealth funds in the Middle East and China and wherever else, have huge amounts of capital. What's the limit on the insurance in an FDIC insured account in the United States today?
150.
It's 250,000, and that's a lot higher than it was before the crisis. It was 100 grand. And if you have 100 grand, and I have a couple of accounts, I have 3 business accounts that I manage that have over 100 grand in them most of the time. Where do you go to put that money to know that you can't lose it? you know, there wasn't a place, now at 250, I don't have that problem, because none of them had more than 250. But, you know, so where do investors go who have 100 million? What do you do with that kind of cash if you want to invest it and just get an interest rate return like you would in a savings account? Because if you stick that in JP Morgan Chase Manhattan Bank at, you know, 0.25%, hoping you at least stay even, and that bank fails, what happens to your 100 million? You get back 250,000. Everything else is gone. So one of the options then is to buy mortgage-backed securities. So these large capital pools are attracted to this because this middleman here, which could be Fannie Mae or Freddie Mac or any other party that wants to do it, guarantees the income stream. So there's three components here, if I got this right. You got the interest income, you get the money that, you know, the interest, right? You got the principal, and then you've got servicing of that. And servicing, as we talked about the other night a little bit, is the process of taking in the payments, making sure the taxes are paid if you're escrow, if the borrower's escrowing, making sure the insurance premium's paid if the borrower's escrowing, and in this case, also getting the principal repayments and the interest payments out to the investor. So if mortgage-backed securities are just as good a quality a guarantee as U.S. Treasuries, that makes them one of the safest investments on the planet today. As long as Fannie and Freddie are owned by the U.S. government, 80%, then you've got the full faith and credit of the U.S. government backing those mortgage-backed securities. So if on 10-year Treasuries the interest rate is, you know, 2.75% or 3%, and I can get 3% on mortgages, maybe I just put the money into mortgages, because this is kind of backed by American real estate. And what's better than that? So tremendous amounts of capital are made available through this secondary market system that otherwise wouldn't be there. And we would not have interest rates that are as low as they are if this whole secondary market and Fannie Mae and Freddie Mac didn't exist. Yep, okay. So the basic idea with securitization is by pooling mortgages of a like type, all 30-year fixed, all the same interest rate, all houses in a particular geography, so that a particular pool of mortgages are fairly homogeneous. So let's just say again, right now around here, current, brand new, right now, 30-year fixed rate mortgages about 3.75%. Crazy low. So over the next 30, 60, 90 days, whatever a particular bank originates in those loans that are all 30-year fixed, same interest rate, same basic risk, following the underwriting guidelines or risk assessment guidelines of Fannie Mae and Freddie Mac, they could pool those together in a group of 10, 30, 50, 100, whatever it might be, and sell them in one big package to Fannie and Freddie, who have the capacity to write the check. And Fannie and Freddie, whichever one buys that, has to have an income. So now they've come up with the principal, replacing the bank's principal, and now they're getting 3.75% interest for almost the next 30 years, whatever's left on the loan. But they don't want to hold those. That's not what business they're in. And they're not in the business of servicing them. So they go to the bank that maybe originated them in the first place, or they hire a servicing company and they say something like, we'll pay you 0.5%. And you service the loans. The payments go to you. Maybe they still go to Old Second, and your loan's been sold and you don't even know it, because you're still making the mortgage payment to Old Second, but unbeknownst to you, they're not the lender anymore. Now they're just the servicing agent. So you still make them the payments, and they forward on the principal and interest to the other parties, and they hold your escrow money in their accounts and pay you no interest, and they make sure your taxes are paid, etc. So there's money to be paid for the servicing. But the investors who have these securities want to know that they're perfectly guaranteed, so Fannie and Freddie, they guarantee the income stream to them. And for that, they say, well, we need some money. So they strip 0.5% off the income stream, plus or minus a little. So now where you had 3.75% available, you only have 2.75% left for the investors, because 1/2 gets paid to the servicer and 1/2 gets paid to Fannie and Freddie, and that's how Fannie and Freddie make money and pay their bills, so long as they're not paying out huge amounts of losses like they were in 2007 and 8 and 9 and 10. And so the investors say, well, we'll take 2.75% because that's the same as we're getting on treasuries, and it's a guaranteed income stream, and we're okay with that. When Fannie and Freddie were privately owned, and there was just an implicit guarantee, I literally used to stand up in front of these classes and talk to students about how the theory was that if Fannie or Freddie failed, the US government would step in and clean up the mess. And lo and behold, that is exactly what happened. Sorry I ever mentioned that, probably jinxed everybody. Because it used to be that there would be a spread between the treasuries and the mortgage-backed securities, because an implied guarantee is not quite as good as an actual absolute guarantee like you did with the treasury bills. So, tons of money pours in here, we get better interest rates, Fannie makes a little bit of money, the investors are secured, and the only question is, does the system make a lot of sense? Well, it's worked pretty well for a long time, it just was recently where it had problems. A conforming loan is a loan that conforms to the underwriting guidelines. And specifically in this case, I want to point out there are loan limits. Fannie and Freddie cannot purchase a mortgage on a one-unit property that's more than $417,800, or whatever that limit happens to be today. I think that's what it is. It's in your text. Hasn't changed in a number of years. That amount is tied to an index that Congress suspended in 2008 because the index was going to go down, and that would have caused its own problems. So they suspended the rules. Now that the index might start going back up again, they'll probably tie it back to that. So there are loan limits. So if you have a mortgage loan, as I did at one time, when my mortgage was $440,000, it couldn't be a Fannie or Freddie loan, because by law, they can't buy it. It's too big. It's what we call a jumbo. So if you've ever heard the term jumbo loan and you wonder what it is, it's large. It's too large for Fannie or Freddie to buy. You could meet all the other underwriting guidelines, but Fannie or Freddie still can't buy it because it's over the loan limit. So there you have to go to a bank that's going to hold it in portfolio or sell it to some other secondary mortgage market participant. So the mortgage that I still have on my house is a portfolio loan. It's through, today it's Capital One. It was ING and Capital One bought their mortgage operation. So again, loans can be non-conforming for any reason, meaning they don't meet the underwriting guidelines, meaning neither Fannie nor Freddie can or will buy them, but one of the most common is just that it's too big. And if you ever want to see what the impact of Fannie Mae and Freddie Mac existing is, look at the difference in the interest rates between conforming loans and jumbo loans. If the theory is right, conforming loans should always be cheaper. The interest rate here should be less money because of the implicit, or now the explicit guarantee to the investors who are putting up the capital in the long run. But sometimes jumbo loans are the same or even slightly cheaper. As right now, I think jumbo loans are probably a little higher, but I'm not sure. It varies a little bit. So it's a little unclear as to whether the Fannie or Freddie system really works or whether it's just bureaucracy that is unnecessary. Big thing here is, again, the guaranteed income stream to those insurance companies, sovereign wealth funds, deep, pocketed net worth individuals who put up those hundreds of millions of dollars, billions of dollars a year. And we're talking mostly about residential. Most residential loans are sold into the secondary market. There are commercial mortgage-backed securities as well. And those stopped completely for 23 months. From 2008 through 2010, for 23 months, not one single commercial mortgage loan was sold into the secondary market. That was 20% of the commercial and industrial financing market in 2007. That completely disappeared instantly and didn't come back for almost 2 full years. And commercial real estate didn't tank nearly like residential did. It never hit the bottom. It came back, it went down later, and it came back much faster. By the way, what trophy property downtown Chicago just hit the market? Willis Tower. What the asking price is, or what the suspected sale price could be? Yeah, $1.5 billion. So if you have some loose change at home, consider that. It was interesting. It's a good time for them to sell. Values are very high in commercial property right now. Last thing here, Ginnie Mae, government agency, always is, always has been, government guaranteed. But again, they don't buy mortgage-backed securities. They never take title to them. They just issue pass-through certificates, which accomplish the same thing. But if we ever go back to a private Fannie and private Freddie, Ginnie Mae will remain a backed by the full faith and credit of the US government, yes.
What was the loan limit again?
417,800. I think that's what it is. It should be in the text, and maybe it's not. It hasn't changed. It hasn't changed for about 6 years. It's tied in through, there's the OFHEO, Office of Finance, Housing, and something, or Enterprise Oversight. A government agency, one of many you probably don't even know exist, and they're tasked in part with overseeing Fannie and Freddie. And it's tied to like a median house sale price or something across the country. And as that ebbs and flows, that amount was supposed to go up and down once a year. But because it was going to go down in '08, they suspended that. But like I say, I expect them to have that kick back in at some point in time. And in high areas, high dollar value areas, that might be different. Because it's really a problem if you're in California and the median house price is 600 grand in San Francisco or 700 grand, how do you get a conforming loan? You can't really do it unless you have a lot of cash. Here it works fine. Most of us are well below that. Illinois, the average price is like 180. California, the average price is like 370. Totally, that's the average, or the median actually. Here's another diagram just to give you a sense of how the whole thing works. I'm just going to skip over this, but for those of you who are interested, just look at it. It's in the PowerPoint slides that are online, or I can email them to you if you want. I just found this online, thought it looked interesting. It's got a few misspellings in it, but I just stuck it in the slides for people to be able to see, because the text is not real clear on how it works. Again, I don't think you need to know tons about the secondary market for your exam or for this class. But I think it's important to understand because it really drives our lending economy. Questions about any of that before we get into some finance math here? Okay. So a straight loan, or sometimes I think referred to as a bullet loan, is the idea that you're going to pay interest only. This is fairly common in business loans. You borrow money, and then all you do is pay interest until the end of the term, and you pay back the entire thing. Corporate bonds are this way. So if you bought a $1,000 bond from the Walt Disney Company, if it's a 30-year maturity bond, all you would get is 2 interest payments a year, no principal, just 2 interest payments a year until the very last payment. You get that last 6 months of interest and the full $1,000 back. That's how a lot of lending works. You can even have interest-only loans in commercial real estate from time to time. They're not super common, but they do exist. Pay back any principal, all you do, just pay that. So the way the math would work on calculating a simple interest straight loan would be like this. Take whatever the principal is, times whatever interest rate you're quoted. So in this example, I'm just saying it's 8%. That's $8,000 in interest, and that's an annual amount. Unless you're ever told differently, you may assume that the interest rate quoted is an annual rate. And that's what we mean when we say 8% interest, 6% interest, 4% interest, that rate of interest per year. So again, the math is 100,000 times 8% or 0.08, $8,000 per year. So if you were supposed to pay that quarterly, you would pay $2,000 a quarter. And you would just do that forever until whenever the loan was due. So if it was a 3-year loan, you would pay $2,000 a quarter until you got to, what would that be, the 12th quarter, and you'd pay the $2,000 in interest plus the full 10 grand back. That's how a simple interest rate loan works. Basic finance formula, principal times the interest rate is going to give you the annual interest in dollars. You want to factor time in here if you're going to modify that from an annual rate. So if the time is more than a year or less than a year, this time factor here will allow you to adjust that. This isn't shown in the book exactly this way, but this is the more traditional finance way to look at the basic formula. Now you will have a question on your final exam, and maybe one at the state exam, at least one, that asks you to calculate interest. So hence the importance of the focus on what we're doing here. So back to our principal times interest rate times time equals interest in our problem. The principal of 100,000 times the interest rate of 8% or 0.08 converted to a decimal times 1, the time, but in this case 1/12 because it's monthly. So it's really 100,000 times 0.08 divided by 12, because times 1/12 and divided by 12 are going to be the same thing, equals a monthly interest payment of $666.67. Same thing, it's just the $8,000 a year divided by 12, because I decided to make this monthly in this one case. So if you're repaying this loan monthly, interest only, your payment's gonna be $666.67 a month until the very last payment, in which case you're gonna also pay back the $100,000 in principal. If you're paying quarterly, this is the example I already talked about, right here, 3/12, 1/4, same thing. So you're every 3 months, $2,000 in interest. And that's all you pay until at the end, you pay back the last bit of interest plus the full $100,000 in principal. Again, straight loan, or term loan, or bullet loan, any kind of loan like that where it's just an interest-only loan for some period of time, that's the formula we're gonna use. Simple interest, no compounding. And this also is the basis for calculating mortgage loans. Mortgage interest calculations may seem like they're compounded, they are not. It is still simple interest. So, let's look at what's in the textbook. I think in your text there's an example of a particular math problem when it relates to finance calculations, so I'm just going to put this up here one piece at a time. If you download the slides, you'll see the full thing. So here's our formulas again, so you can learn those if you're good at memorizing formulas. I never really think that way. I just sort of mechanically do what I know I need to do. So the problem they give us is that we have a loan of $70,000. The interest rate is 7.5%. That's going to be $5,250 a year, right? 70,000 times 0.075 is $5,250. I have not made any adjustment here for time at all because I don't have to multiply it by time here. If I want to look at the monthly amount, I can simply divide the annual interest by 12 months. That's the same thing as multiplying times 1/12 like we did before. So if you tell me I've got a $70,000 loan at 7.5% interest and $5,250 interest per year, my monthly interest is going to be $437.50. That's just the annual divided by 12 months out of the year, right? Relatively simple. Again, this is all in the window, in the text. The reason that we're going to talk about this is we're going to look at this in a couple of different ways to better learn it. It will also form the foundation of the math question you're going to need to answer on the final. Now, they've given us a fact in this problem. They've told us that they've given us there's three givens in the book. It's a $70,000 loan that's given to us. It's a 7.5% contract interest rate, and the monthly principal and interest is $489.30. They gave us those three things. Common starting point for a mortgage math problem. We'll come to in a minute where that $489.30 comes from and how we can verify and prove that it's true. For now, we'll just take them at their word. So if in your first payment on your $70,000 loan at 7.5%, your principal and interest payment is $489.30. We're not talking with taxes and interest in insurance here. It's PITI normally, right? But we're locking out the taxes and the homeowner's insurance because we don't care about those right now. We're just talking P&I. So that's what you've got to have in your first month's payment, and if that's interest, then the difference is going to be the principal amount that you're paying.
5180.
There it is. Good calculation. So $51.80 in principal. So what that means is that in the first month, when I make my $489.30 mortgage payment, I've reduced my loan balance by $51.80. So I have an opening loan balance of $70,000, but my end of the month loan balance is now $69,948.20. So this is the manual process, without having to use an Excel spreadsheet, without having to memorize a formula, without having to do anything but follow these steps. This is the manual process of how you would calculate the impact of 1 month's payment on your loan balance. Okay? And I'm going to give you a problem like this on the final exam and ask you to give me one of three things. I will either ask you to give me how much interest was paid for the month, or how much principal was paid for the month, or what the loan balance is after the payment is made. One of those things. So you're going to want to be able to calculate all the way down to the bottom. And one problem. Why? Because in real practice, you can do this with an Excel spreadsheet, or get an amortization schedule from the bank, or you can do it with a financial calculator. But I am told that a question like this on the state exam could exist. So you need to look at that and be prepared. All right? questions about that? Ken, that's in the text. Ken, go ahead.
How did we go from 437.50 to 489.30?
489.30 was a given. So in any math question, remember, we don't question the givens unless we think it's distracting information. So if it said there's an $80,000 sale and a $70,000 loan, the $80,000 sale is meaningless. That we set aside. But in this case, if they tell us what the P&I is, just go with it.
So it doesn't matter if it's right or wrong.
It'll be right for the purpose of the test question.
Right.
Now, here, it isn't a bad thing for us to take the time and say, where did that come from? So where did that come from? In your book, there's a mortgage rate factor chart, and we'll look at that in just a minute. In the meantime, since I put this up here and it's in red, and that makes it really pretty. This, what we're calculating, what we're talking about, is a 30-year fixed rate, self-amortizing level payment loan. Meaning, the interest rate is not changing across the entire loan. The payment of $489.30 is fixed. That does not change. But what happens inside that payment is different every month. Because when we go to do this calculation for month 2, our opening balance won't be $70,000, it will be $69,948.20. We're going to look at this. We're going to run the second month's calculations to see if there's a slight difference. But the principal and interest is the same. That's what we do. We have level payment loans. Even if we have an adjustable rate mortgage, it's a level payment loan until you adjust, and then it's level again until you adjust, and then it's level again until you adjust. Not all loans have to be amortized that way. Not all loans historically were amortized this way. But this is the most common, popular, in human history as far as we know, type of real estate loan that has ever existed. The world has kind of gotten comfortable with this idea of a level payment loan, where the amount of interest and principal you pay every month varies, but the loan payment itself is the same. Okay, so here's our first month that we just ran through, right? That's what we just got done looking at. All the math is there without some of the extra verbiage. So what's the second month going to look like? Again, opening balance is a little different. Now it's $69,948 times the interest rate of 0.075. And if you cannot convert percentages to decimals, I suggest you learn, study, practice. These are the same thing. You know, this is, just shift this over, 7.5 per 100. So 2 places is 1/100th. Percentage is literally means divided by 100. So the interest for that year would be $52.4612, but we make our mortgage payment every month, so we divide that interest by 12, or if we wanted to use the other formula, $69,948.20 times 0.075 times 1/12, and we're going to get a monthly interest payment in the second month of only $437.18. Right, so it's 32 cents less, which means the principal's 32 cents more, which means that we're paying the loan down a little bit more, right? So our final loan balance now is $69,896.08. And I'm glad you did that little hooting and hollering there from Ken, because look at that, ooh, we're almost paid off, right? Not. If you've ever, toiled under this, 30-year loans take forever. Well, they take 30 years, but it feels like forever. You pay off maybe 1% or less in the first year. There's a chart in the book that shows pretty well how you pay off very little, and then it starts to accelerate fairly quickly after you've been out 7 or 8 years. I was trying to remember the other night when we were talking about, I think it's been now close to 8 years that I've had my current loan, the longest I've held a residential loan on the same amortization schedule. And I'm noticing that I'm paying off a lot more principal from time to time now than I was when I first took out the loan. All right, so that's month 2. So now you can replicate that. Taking a look at our mortgage factor chart to determine our monthly principal and interest payment, because we don't necessarily want to accept that it's just true. You will not have a mortgage factor chart question anywhere, I do not think. But it's not a bad thing to be able to do. You can get mortgage rate charts from lenders. You can get them online, where you literally can see how many dollars per thousand you would borrow at every conceivable different interest rate and term. So if you're trying to help somebody calculate something, you don't have a financial calculator or don't know how to use one, you could do it manually in this way by looking at a mortgage factor chart. So it's not a bad thing to look at. So when we look at our chart, if you've got the book handy, look at the contract interest rate of 7.5% and the term of 30 years, and underneath that, what do you find? There'll be a factor there. So again, go down and over, and you'll find a factor of 6.99, which means $6.99 of principal and interest repayment per $1,000 of the loan. And in our example, our loan was for how much? $70,000, right? So we should be able to take 70, right? 70,000 divided by 1,000, or 70 times the $6.99, and look, there we go. There's our principal and interest payment of $489.30. So some guy who's a lot smarter than me, and I'm assuming it was a guy because it was probably done a century ago, and I don't think women were allowed to, use abacus or whatever they used in those days, to calculate this, and just went through and created all these charts. So you don't need a fancy calculator or to know the formula, you just look it up. And they did it on a $1,000 amount, and then the chart works, it tells you how to apply that. So as long as you have the right chart, you can figure this stuff out. All right. So again, there we go. Now what happens if we cut this loan in half in term? If we go from a 30-year amortized loan to a 15-year loan, is that going to double our payment if we have to pay it in half the time? Does that make sense? I got some yeses, sounds like some no's. I can't really hear. What does it do?
It cuts down your interest.
Well, it'll cut down your interest, but you got to pay it in half the time.
Your payment goes up,
How much does it go up?
like $100 or something.
It's not going to double?
No,
Pay it in half the time?
no.
Why?
Because you're losing.
Because of the amortization.
Really? Because if you were amortizing it, wouldn't it still be the same? I mean, if all this is the same, aren't you going to take that and still come up with this per year and still come up with this per month? You'll have, the only thing that'll be different will be that amount, but you still have the same amount of interest, right? What do banks do when loans are longer or shorter? So in this case, if a loan goes from 30 years in length to 15 years in length, same property, same borrower, assuming the borrower can qualify for whatever they want, what does the bank do with the interest rate? Anything?
Drop it.
You think they'll drop it? Anybody else? Why do you think they would drop it? Why would a bank lower the interest rate simply because you say you'll pay it back in 15 years instead of 30?
So they can refunnel that money.
Maybe what if the interest rates are lower? Then they don't want to, put that money back out to work because now it's going to be at a lower rate. You're right, they do drop it, but it's not for that reason. They do it because time is a risk. The longer a loan is out there, the greater the chance of default. Plus, let's go through this exercise. Okay, let's just say right now, today, that 30-year fixed rate money can be had at most financial institutions with good credit for 3.75%. That's right, that was today. Today's Thursday. If I asked you to bet $50 and be within 1/8%, would you be willing to take that bet that you could predict the rate tomorrow, that it would be no less than 3 5/8 and no more than 3 7/8? Would you take that bet?
No.
It's just tomorrow. You aren't willing to predict the interest rate tomorrow. What about next month?
Definitely not.
How about in a year? How about out 5 years? How about out 15 years? How about tell me, what's the interest rate going to be 30 years from now? You see how we go farther out in time, the possibility of prediction becomes more and more absurd? So the banks recognize that there's a big difference between trying to guess out a 15-year period and trying to guess out a 30-year period. And I would say that the interest rate's probably typically today 3/8 to 0.5% less going from a 30 to a 15. It's significant. So if you recognize, in our example here, let's say because we have a higher interest rate at 7.5, we're going to assume, first of all, that we're going to have a 7% rate instead of 7.5 because it's shorter term. And if you want to know what that spread is, just look up any bank's interest rates, and you'll see the difference. It'll vary. It'll be a little different from bank to bank. So now go to your mortgage factor chart and look up the factor
It's 898.
8.98. All right. So we still have a $70,000 balance, and we have 7% interest now, so our interest per year is less. Not because of, not the house isn't different, the borrower isn't different, but the interest rate risk for the lender is different. So a shorter term loan will typically have a lower interest rate, right? When you go to an ARM, what happens to the rate? It's less because the interest rate risk is less because the period over which the bank is guaranteeing that lower rate is shorter. 4,900 divided by 12 is 408.33 per month. And then our payment at 8.98 is 628.60. Not anywhere double 489.30. So it's not quite as good as what Georgie was suggesting of $100, but it's pretty close. A lot closer than double, right? So our payment is $628.60, and of course, if a borrower is comparing the two, the borrower has to be able to qualify for both. Right? I mean, if you qualify for $489.30 and you don't qualify for $628.60 a month, then this whole exercise is meaningless, right? You have to have enough income that the option is viable. So at $408.33 a month in interest and $628.60 in P&I, we're paying down $220.27 in principal. Good Lord, that's 4 times as much as we were paying before. So it ends up that we're paying a loan down a lot faster, and we're not paying more interest, we're paying a lot less. So let's take a look at what the overall difference is between these two loan options. This is the same thing we just looked at. Yep, okay, looked at that. So, if we have a 30-year loan, right, we have 12 months in every year, we have 360 payments. So our total is going to be $176.48, principal and interest. Make sense?
So they're making $106,000.
Right. Well, they're not, it's not their profit, right? I mean, they got to pay for that money in some way, but basically, yeah, there's a lot of interest there. And our interest rates are a lot less, so the numbers would be lower if we were using current interest rates. If it's a 15-year loan, 12 months still out of the year, 180 payments, half the number of payments, only $113,148. So to really compare them side by side, on a 30-year loan, as Ken was pointing out, it's a $106,148 interest charge. On 15, it's 40% of that, $43,148. The difference is huge. So at a minimum, I suggest you understand enough about long-term mortgage finance to be able to encourage your buyers to think seriously about what kind of loan arrangement they take out. I marvel at the real estate brokers who say to their clients, hire me because I'm a really good negotiator. I probably used this terminology earlier in the class. If you are a good negotiator as a buyer's agent, you might be able to save your client, what, a few $1,000s?
But if you know this, you're gonna save your client $70,000.
Where's the real money in real estate?
Right there.
It's in finance. Consumers who borrow intelligently or who save and never borrow save tons of money. So again, it's important information to have and to be able to understand and to be able to follow. If math isn't your strong suit, this may be challenging. If you're gonna work with buyers, I suggest you either have a really good mortgage loan originator, either at a bank or a mortgage broker or an in-house lender or somebody that you can rely on to help steer your clients in the right direction. If you're not gonna work with buyers, then this isn't quite as important to you. But it might be important even just on your own borrowings. I can tell you, in commercial real estate, when you get loan offers from multiple lenders, they don't look even remotely the same. You gotta sit there with 3 or 4 or 5 different loan offers that don't, different term, different interest rates, different prepayment penalties, different equity amounts, just different everything, different fees, and try and figure out which one is better. You have to be able to run exercises like this, or you just can't figure out which is the way to go. All right. Questions about any of this at all? And let's take a break. And we will come back at 5 till, and we'll pick up and talk about other ways we can reduce interest expenses on banks. If we're not back at 5 till, no later than 8, but try and get back earlier rather than later.